In this lecture, we will be talking about merchandising companies because merchandising companies have inventory. So a merchandising company is a company that buys this product and then resells that product to its customers. And so those goods that the merchandising company buys, that's known as inventory. And inventory is an asset. And that's how merchandising companies generate the main source of their revenue is selling their inventory, selling that product. So you can refer to it as merchandise inventory, but a lot of times it's referred to as inventory for short, versus if you're in a manufacturing company, then you will classify your inventory into 3 different types of categories. But for this lecture, we're going to be focusing on merchandise companies who have just their goods available for sale, their merchandise inventory, or inventory for short. Now, when a company, I should start out first, when a company first buys their inventory, they're not making their product that they're going to sell. A merchandise company is purchasing this from a supplier. So they purchase their inventory from a supplier, and when they purchase that inventory, it's recorded as an asset, so nothing's being expensed yet. But as the inventory is used up, as the inventory is sold, an expense is recognized, and that's known as cost of goods sold. So cost of goods sold is the cost of inventory a business has sold during the period. Cost of goods sold, it functions like a normal expense account. It's recorded on the income statement. So this chart here is a nice summary of the flow of costs of how inventory flows within a company. So a company might start out with some beginning inventory. We see that in the top left corner here. They would have some products that they've purchased, from the prior period. Then they would make some additional purchases during the period to keep their inventory stocked. So they would have the cost of goods purchased. And then the beginning inventory plus the cost of goods purchased or purchases would equal the cost of goods available for sale. So that's just the total amount of inventory that's available for sale for customers. Now, you're seeing a lot of cost terms. So inventory is recorded at cost. So whatever the purchase price is for that inventory, the cost of it, that's what it's recorded at. And then when it's sold as an expense, it's recorded at cost. So it comes in at cost and it flows out at cost. Now, as items are sold, right, that's reflected as cost of goods sold as an expense on the income statement, and that would decrease inventory. So as you sell your inventory, you see the reflection of that expense on the income statement, and then on your balance sheet where the inventory account is held, the inventory account would decrease. And then whatever's left after the amounts that you've sold during the period, that would equal ending inventory. Now there are 2 main inventory systems, periodic and perpetual. So with a perpetual inventory system, this is where a company is maintaining records. They continuously know the items they've sold. They continuously know after each sale transaction, what's left. So this would be known as a perpetual inventory system. They know the amount of cost of goods sold during the period with each sales transaction. Now, a periodic system, the company does not have a system in place to continuously keep track of their inventory. So how do they figure out what's been sold? Well, you can summarize that with this formula here. Beginning inventory, so they would know how much they start with. They can perform an inventory count. They know how much they start with, plus what they've purchased during the period, new purchases of inventory. Again, that would equal cost of goods available for sale during the period. And then what they're going to do is at the end of the period, they are going to count how much inventory is left. So what's left on hand? They're going to perform an inventory count. So if they know how much they started with and then they know how much they ended with, they can subtract the 2 and then figure out what they sold during the period. So you see that final calculation, you subtract ending inventory from the cost of goods available for sale, and that gives you cost of goods sold. So for example, putting some numbers to it, $100 $200,000 in beginning inventory for a company, plus purchases of $800,000, goods available for sales, the $900,000. Well, then at the end of the period, if they count up their ending inventory and they have $125,000 worth of inventory left, then cost of goods sold would equal $775,000. Now, what do companies primarily use? Well, typically it's a combination of both. So most companies will use a perpetual inventory system throughout the period. They'll know barcodes, for example, when it's scanned at when that sale occurs. They would know what's being sold, the units being sold. They would know how much is in ending inventory. Their system would update. But then at the end of the period, they're still going to perform a physical count, because inventory can become lost or damaged or stolen during the period. So companies would still perform an inventory count at the end of the period to then make sure that their accounting records reflect what they physically have in inventory. So they'll perform a physical count at the end of the year, and that will help them update their ending inventory and their cost of goods sold amount. So let's look at a few examples of recording merchandising transactions. And first, we're going to look at the perspective of purchasing inventory, so buying inventory, and then we're going to look at the perspective of selling inventory. So we have this company, SS Stereo, and they purchased inventory on account from PW Audio Supply at a cost of $3,800. So how do we record that transaction? So first, it's important when you're analyzing transactions, especially in this chapter for merchandising companies, first ask yourself, are you the buyer or are you the seller? So we are recording transactions for SS Stereo, and they're the ones that purchased inventory. And so they purchased inventory. So we have the inventory account. This is going to increase. And then it was at a cost of $3,800. But it's important to note that this is on account. So this is not going to be cash. So when you see a purchase on account, you're going to use accounts payable. So again, the company is getting inventory, so the inventory account should be increasing. But then since they're purchasing on account, they need to increase this liability. Accounts payable represents the future payment of cash for this inventory they bought. Now, this doesn't have an effect on the income statement yet. When they first purchase the inventory, nothing's being expensed. It will be expensed later on as it's sold. Now, let's say that SS Stereo, they purchase something, they purchase this inventory, and then they want to return it. So let's say the inventory they're returning has a cost of $300. And so when there's a return of inventory, you're no longer going to have that inventory, so the inventory account is going to decrease. But if you purchased it on account, for example, your accounts payable is actually also going to decrease as well, because you would no longer owe for goods that you're returning. So your liabilities should be less. And again, no expense accounts, no revenue accounts were involved in this transaction, so no effect on the income statement. Now let's flip over and see what it looks like on the seller side. To illustrate a credit sales transaction, so this is telling us that this sale is going to be on credit. PW Audio Supply records the sale of $3,800 to SS Stereo. So we're actually looking from PW Audio Supply's perspective when they first sold it to SS Stereo. SS Stereo was the buyer who we were looking at in the previous two slides. So let's say this merchandise cost PW Audio Supply $2,400. Now, when you record transactions for the sale of inventory, there's always going to be two parts. There's going to be the first part, which accounts for the sale, and then the second part, which accounts for selling that inventory, that decrease in inventory, and recognizing the expense. Now, this was on account, so $3,800 under accounts receivable is increased. But then 3,800 in revenues, specifically sales revenue, is increased. Now, this is the sales portion. So notice how this is recorded at 3,800. This is the price. This is the selling price, right? PW Audio Supply records this sale of 3,800. So PW Audio Supply has set this selling price, right? They'll determine and set appropriate selling prices for their merchandise. So when you record this first part, the first part of this transaction, when you book the accounts receivable and the revenue portion, the sales revenue portion, that's always at selling price. Now, I mentioned there's a second part of this transaction, and that's for accounting for the inventory. Now, it cost PW Audio Supply $2,400. They're selling this inventory. They're getting rid of this inventory, so the inventory account decreases. Now, also, you have cost of goods sold involved. So remember, cost of goods sold, this is an expense. And as inventory is sold, as it's sold, this expense, cost of goods sold, is going to increase. So it functions just like any other expense transactions that we record. It's going to decrease retained earnings, decrease stockholders' equity overall. So notice how this second part of the transaction, of the sales transaction, is at cost. And so that these two rules you'll always follow. So the sales portion of the transaction always at selling price, and then the inventory cost of goods sold portion always at cost. And that's following along the concept that inventory is recorded at cost. So we record inventory at what it costs the company. So as you sell the inventory, it also goes out at cost. It comes in at cost and then also goes out at cost. Now, PW Audio Supply, they had some goods returned to them from the customer, and that was SS Stereo, right, who returned the goods. And the goods had a selling price of $300, but then it also gives us information about the cost of the goods. And so we're going to have a two-part transaction for the return of this merchandise. So first, since they are, and again, remember we're in the seller perspective, they sold this inventory, they increased their accounts receivable. This was a sale on account, so they had increased accounts receivable and increased their sales revenue. But now that they're getting inventory back, they no longer are going to be receiving the amount for that inventory that was sold. So that's why they decreased the amount that's owed to them from the customer, minus $300. However, revenues is also decreasing. So you have a decrease to accounts receivable and a decrease to revenues. And the way this is recorded for returns, you use this account, companies will use this account called sales returns and allowances. And as goods are returned, as allowances are given, as this increases, this will decrease revenue overall. So this is where you get the term net sales, because a company will initially record their sales revenue, but then if there's any amounts in sales returns and allowances, that will be netted against, it will offset the sales revenue, it will be subtracted from sales revenue to arrive at net sales. So as sales returns and allowances increase, retained earnings will decrease and stockholders' equity will decrease. Now there's a second part of this transaction, which is recording the inventory. So the goods cost $140. So these are the items being returned. So since they're getting the inventory back, the seller is getting the inventory back, inventory is increased, but then cost of goods sold is actually reversed here. So we have a plus 140 for expenses. So usually when you record expenses, this is a decrease to retained earnings, it's a decrease to stockholders' equity. But if you're getting the inventory back, those items are no longer sold, and therefore you're reversing. It's like you're reversing part of the prior transaction.